Okay, can you hear me at the back? Nope. What about now? Better? More? How's that? Okay? Great. Okay, so this is Accounting 2102. Thank you very much for coming to your lecture. We're doing Introduction to Management Accounting. My name's Robin King. I'm the course coordinator and the lecturer for this course. So today we're going to introduce you to some new management accounting terms, as well as try to get you oriented to the course more generally. So as well as myself, the person who was in the room just before was the Associate Lecturer for this course, Mr. Kevin Tai, and you're able to get in contact with us using these contact details. I'll have consultation on Wednesdays from 12:30 to 1:30 and also 4:30 to 5:30 after this class. You're very welcome to come to consultation. I'd like to see you. I'd like to help you to do well in this course. So please feel free to contact me using this information. Okay, before we get on to the course aims, I just want to talk to you about the Blackboard site, because we've made some changes. If any of you have done this course before, you'll notice some changes compared to last time you took the course. So I'll just put it into the student preview. We have the usual information on the announcement page in relation to your prerequisites. So if you haven't done 1110 or 1101 plus 2101, just be really aware that I am assuming that you have that knowledge in this course. So you need to understand the accounting equation and how to write journal entries. And if you don't understand that now, it'd be great if you came to talk to me during the break about what your options are. Because we do move fairly quickly through this course, and so you might struggle a little bit with the journal entries, etc. Okay, also this course, they have announced that they're going to use it as a trial and they're going to actually transcribe the lectures. So you'll actually have a transcription of the lectures. So when you listen to the lectures, you can actually see what I've said, which is a little bit scary for me, but hopefully is useful for you. I hope that you've all had a chance to look at the welcome video, because it does provide you with some information that's very useful for this course. But getting to the learning resources, so what we've tried to do is make this a little bit more interactive and user-friendly. So we have all the lectures in the course structure up front, and you click on the lecture. There's a discussion Padlet for each topic, so you can post your queries and you'll get a response from course staff on Mondays, Wednesdays and Fridays. We'll be checking this discussion board, but you're most welcome to respond to those questions and queries yourself as a fellow student. But we just thought it would be helpful to have some discussion associated with each week's material rather than having to look through threads. So when you click on Start Course, what you'll see, and hopefully some of you have already done this, are the objectives for the week. So what we want you to focus on, understanding. There'll be a video in most weeks that we'd like you to watch prior to coming to class, so that you have some concept about, in the real world, how management accounting works and why it's meaningful to learn about management accounting. Then in the next item, we have what part of the textbook we'd like you to read. for each week. And so this is the text. I would really encourage you to have access to a text, whether that means buying the text physically or buying the online version. Or there are some copies in the secondhand bookshop, because all the tutorial questions are in the text. And this text will be useful not just for this course, but also for 3104 if you go on to do that course. So I'd strongly encourage you to have access to a text. So for some weeks, you can actually click on this material, and Corinne has kindly given you a summary of what we're focusing on in class. Certainly this is not all the material, but it allows you to work through some major points. So you can just keep clicking through and you'll see more of the material. So then the next item is you can download the lecture slides, 1 slide per page, 3 or 6 alternatives. And then after you've completed your tutorial, and the tutorials are staggered, so they don't begin this week, they begin next week, and I hope you all have signed up for a tutorial. So next week, after all the tutorials are finished, this item will become available. So you'll be able to do a quiz, which is formative, it's not summative, so it doesn't count towards your assessment, but it allows you to practice the kind of MCQ questions you'll have on your assessment. And give you some indication of how well you know the material. You have to do the quiz, physically do the quiz, to access the tutorial answers, which will be released at the end of the week of the tutorials. So we want you to try the tutorial questions without the answers in front of you, because from past experience, I've found that students who have the answers in front of them actually think they know how to answer the question and then get into the exam and can't begin to answer the question. And we've also created some extra resources for you. So, for example, this week, at the end of the lecture, we're going to do an exercise creating a cost of goods management and sold schedule. You need to be able to do this. It will be on your assessment. And so I've made a video of the example that you can access after class today, demonstrating how to do it. So you don't have to go back through the lecture recording to get to the example. You've got it separately. Does that make sense? Okay, and in other weeks there'll actually be some animations explaining things like process costing, and we'll also have some animations and some videos of demonstrating how to do past exam questions later in the semester for the final exam. So hopefully you'll find those resources helpful. Do you have any questions about any of that? Okay, and you'll also find outside of the RISE module, so that's this module, after today's, so this is the last lecture for today, or the week, at 4 p.m, the lecture recording will become available in that week, okay? In week 4 of semester, we have exhibition holiday on the Wednesday, so I'll do an online lecture for that week. They'll still have, you'll still have tutorials that week, because most of the tutorials are not on a Wednesday. Okay. The only other thing I wanted to show you here is we have all the course staff information. So we have 9 tutors. So all of their contact details and their consultation are available in the course staff folder. Okay. So getting back to today's lecture. So what's the purpose of 2102? So you probably have done financial accounting courses already, but this is management accounting, and some people find it a little bit more challenging because we cover a lot of tools and techniques that management accountants use. So what's the purpose of this course? We want you to be able to contribute to value creation in organisations by providing managers with useful information for decision making. So we're going to teach you some tools around costing, around planning and budgeting, and also in relation to activity-based costing and process costing. So you will be able to add value because you will be able to understand how costs behave and the accounting treatment of different costs and how that impacts on a company's overall performance. So hopefully you'll feel that this will benefit you not only in your future careers, but in your personal life as well. Understanding about how we cost something, a product or a service, how we price that product or service, and therefore also how we make decisions about future costs, budgeting and planning and controlling those costs. As I said, that's the text. If you purchase the text, you also can access My Accounting Lab, which isn't compulsory, and you're not set any homework or work out of My Accounting Lab. It's very useful for exercises to remind you about accounting, but also to practice MCQ questions, etc. The tutorial questions out of the text, there's a list of questions for each week, and there's 2 columns in that list. One column are the questions we're going to cover in the tutorials, and the other column are for you to do in preparation also in the tutorial, for that week. So that list is available in a folder under Learning Activities in Blackboard. So as I said, you've got the lecture notes, you'll have a lecture recording, the tutorial questions. The solutions will come out on the Friday at the end of the week of your tutorials. So you'll have access to the written answers. And as I said, there's no lectures in week 4, but you'll have an online lecture. In week 6, there's no lectures or tutorials because we're having our online quiz. So there's no traditional mid-semester exam. There's no Saturday exam. There's an online quiz that will take place in your lecture time. So you need to be, and I'm sure I'm talking to all the people who've done the right thing, but you need to be enrolled in a lecture to be able to access that online quiz. So, for example, if you're enrolled in this lecture, you can access that quiz anytime between 2 and 4 o'clock on Wednesday, the 28th of August. The quiz you'll have 90 minutes to complete the quiz. You don't have to be here. But if you access the quiz at 10 to 4 and you close it at 10 past 4, you can't get back in. Whereas if you're in that 2-hour period and you close it accidentally, you can get back in. Is that all good? Yeah. Okay. So I'll talk to you more about assessment now. So that quiz is worth 20% of your overall mark. Obviously, it's open book because you won't be under exam conditions. It'll be 90 minutes in duration. There'll be a combination of MCQ, but also 3 short answer calculation type questions. I'm going to be fairly specific, telling you what we're going to cover, but it's on the 28th of August. So the same rules apply if you can't do the online quiz on that date as apply if you can't do your mid-semester exam. You have to apply for a deferred, okay? I'm hoping that everyone will be able to manage, or the majority will be able to manage it on that day, and then I'll be able to release your results fairly quickly and you'll have them before you do your case. So there's 2 case studies, individual, 15% each. The first one is on activity-based costing. The second is on relevant costing and decision-making, which is topics 7 and 8. The first one is traditional. You'll be given a case, a series of questions, and you'll have to write a response and upload that to Turnitin. The second one we're going to do in Cirrus, which is an annotation software. So your responses will be that you need to highlight parts of the case and provide an annotation as a response to each question. And it'll be colour-coded. So for the first question, you'll highlight in particular colour the parts of the case that help you to answer that question. But I'll give you heaps more information closer to the time. They'll be open for a couple of weeks. They shouldn't take you a couple of weeks to do. Okay, they're like an extended version of your tutorial questions. They're not a 15-page case, they're more like a maximum 5-page, okay, to read. So then we have the final exam, which is 50%. It's traditional, it's an exam period, and central examinations will let us know the date and time of that. But we won't be re-examining the material that you've done in your case specifically. Everything builds on itself in this course, but we'll be specifically looking at topics 6 to 11 in that final exam. Okay, any questions about any of that? Okay, I will give you more detailed information closer to the time. So the usual expectations that you attend your lecture and your tut, hopefully having read the material that's set in your text and preparing your tutorial questions. So please check your Blackboard regularly for announcements. I don't tend to email you unless it's something really important, because I know you get a lot of emails. Yeah, it's up to you to keep checking Blackboard for announcements and discussion board if you have a question. All good. I think all I want to emphasise here is that the consultation times tend to be really poorly used, and I wonder if it's because students think that we don't want you to come to consultation. We actually do want you to come to consultation. We want to help you to do well in this course. So please make use of our time. We'd like to help. Okay, so the structure of the course. We've broken it into parts. So initially we're just trying to introduce you to these concepts of managerial accounting and cost accounting, and that's what we'll be doing today, including learning some cost terms and how to develop a cost of goods manufactured and sold schedule. Next week we're going to talk about cost volume profit analysis and costing behaviours. Then we're going to get more into costing systems, where we look at job costing, cost system refinement, activity-based costing and process costing. Then we get into kind of relevant costing. We'll talk about decision-making and relevant costing in over 2 weeks. And the final part of the semester is about budgeting and variance analysis. And we will have a revision lecture. And it all builds on itself. So please try and keep engaged with material, because I do believe that this course is doable in the sense that you should be aiming to get a very good mark. Okay, so today's objectives. What we want to do is talk about what is management accounting and explain how it's different from financial accounting. We want to explain strategic decisions, because management accounting is about providing information to managers to assist them to make strategic decisions. So we need to define what we mean by that and what we mean by the value chain, because really we can think about any organisation in terms of its functions, and those functions should be trying to enhance value for customers. So management accounting is about providing information to assist in that process. Then we're going to talk a bit about ethics for management accountants, because it's very important that you have some understanding of the expectations of the professional bodies. We're going to talk about then the language of management accounting, and particularly the cost accounting. So there are particular meanings of terms that you need to understand in the discipline of management accounting. So we're going to introduce those terms and then we're going to apply them in a manufacturing setting. So you need to understand the difference between manufacturing, merchandising and service firms, and then we're going to go on to do a practical application so that we can calculate the cost of goods sold for a manufacturing firm. And that means that we have to be able to explain how costs flow through inventory accounts in manufacturing firms. And this is what I will also demonstrate in the video that I told you would be available online in your Blackboard site. Any questions? Okay, so management accounting. What is management accounting? So management accounting is the kind of umbrella term, and cost accounting is part of management accounting, one part of management accounting. So management accounting is about measuring, analysing and reporting financial and non-financial information. So management accountants might also collect qualitative information about their customers, their suppliers, their competitive environment, and create reports to give to managers to assist them in making decisions. Basically, that information is used to develop, communicate and implement strategy. Cost accounting, as I said, is a subset, and it's about measuring, analysing and reporting financial and non-financial information that relates to the costs of acquiring or using resources in an organisation. So why do we care about costs? Why, if you're running a company, do you care what your costs are? What's it going to affect? Your profit? And what do you use cost for? So I know what my costs are. What do I use that information for? For my budget, I forecast my costs to see what my profit... Yeah? Make decisions. I'm looking for a specific decision that you have to make. If you produce a product, you want to know what the costs are for that product so you can do what? Yeah, how many, but also how much you're going to sell that product for, how you're going to price the product. So unless you know your costs, you can't actually price the product in a way that's going to make a profit for your organisation. If you don't make a profit, what happens to your organisation in the long run? Yeah, it shuts down, liquidate. Okay, if you're making continuous losses, you're not going to survive into the future. So what we're talking about in terms of management accounting is that we refer to these systems within organisations that create this information in reports. These management accounting systems are all different. Every firm has a slight variation in the way that they produce information for managers. So one firm might produce very accurate costing information on a weekly basis, and another firm might have less accurate costing information, and they may only produce it every 6 months. And what drives those differences is what they're producing. Okay, so if I'm in an organisation where I have no competitors, I produce a unique product that has high demand, I probably am not that interested in having really accurate, detailed costing information because I can charge whatever price I like for my product because I've got no competitors. Whereas if I'm working in an organisation that has heaps of competitors, there's lots of similar products out there, and I'm trying to compete on price, I'm going to want to have very detailed information, as accurate as possible, up to the minute, about the costs so that I can keep doing things, making decisions to shrink my costs, maximise my profit, while still having a competitive price. So what your management accounting system looks like is driven by the nature of the product or the service, what it is, the production process, how it's produced. So if I produce something where I can monitor at a very low cost how much input, how much material, how much labour, how much overhead goes in, it's going to be far easier for me to have very accurate costing than if I produce something that's mass-produced and has lots of overheads using machines that I can't very cost-effectively allocate those overheads to each unit of product. My management accounting system is going to look quite different. As I said, the nature of the competitive environment will drive the type of management accounting systems, and the costs of the system versus the benefit of the system will always inform what the system looks like. So managers are always going to try and choose a management accounting system that maximises the benefits and minimises the costs. So to have very accurate costing information is costly. Okay. So we also want to understand the difference between management accounting and financial accounting. So I hope you're all familiar with financial accounting from your previous studies, where you're creating financial statements for external users. So you're creating balance sheets and profit and loss statements and statements of changes in owner's equity for external users. And they're people like shareholders, banks, the ATO, all to assess the company's financial position and performance and make decisions. Am I going to invest in that company? Am I going to loan money to that company? But management accounting, it's more about internal users. We want to give information to managers to help them make better decisions. So therefore, what's in those reports, those management accounting reports, differs from financial accounting reports. Financial accounting reports have financial figures, numbers. Management accounting reports, as I said, can be both financial and non-financial information. It can be future-oriented, so you might produce budgets, whereas financial accounting is interested in historical information, recording transactions of recording past transactions that have taken place in the accounting system and then producing a report that tells you what's happened in the past. Management accounting doesn't have prescribed rules in the sense that financial accounting does. If you produce a financial report for an organisation for external users, it needs to comply with GAAP, so generally accepted accounting principles, ASIC if you're a publicly listed organisation. But your management accounting reports, they're internal. So there's no prescribed rules. Basically, it's a cost-benefit analysis. We're not going to produce a report that has really accurate information if there's no benefit of that accurate information. So we can report hourly. We can report daily or weekly, whereas in financial accounting, it tends to be your annual financial statements or your quarterly report, sometimes half-yearly. And for the company as a whole, whereas management accountants can produce reports for a particular department within an organisation, you might report on a particular employee and benchmark that employee against employees in other similar organisations. So these, jumping ahead. These management accounting reports are designed to influence behaviour of managers and other employees within the firm. So you want people to make better decisions based on the information that you provide them. Whereas financial accounting, it tends to influence behaviour of employees if it's linked to their compensation. Say, for example, the CEO gets a bonus if they hit a certain amount of profit. Okay, so we usually as you can see, management accounting has different users, a different focus, different time spans, and different behavioural implications. Okay, so remember I said management accountants are trying to produce information for managers to make better strategic decisions. So I know that strategy is taught in a lot of courses and has a different meaning sometimes across courses. For the purposes of management accounting, this course, we talk about strategy as how an organisation matches its own capabilities to the opportunities in the market. So we tend to use the different categorisation of strategy as cost leadership or product differentiation. And I know there's lots of different labels that people use for different strategies, but we tend to stick to these fairly simple labels in this course. So what do we mean by cost leadership? We're talking about companies that produce products that they want to produce at low cost and compete on price. Okay, so they tend to be products where there's lots of competitors in the market, whereas product differentiation strategy is when you want to produce a high quality, unique, it has some characteristic other products don't have, and therefore you can charge a higher price. Is everyone good with that? Okay, so we want, having had the board of directors and the executives set the strategy for the company, as management accountants, we want to come along and provide information that assists those managers to achieve what they set out to achieve in their strategic objectives. So we want to provide information that gives the company competitive advantage. And that strategy, no matter how good it is, if you don't implement it effectively, evaluate it, and then provide feedback to make changes, it's not going to be useful. So we're providing this decision support. And if we think about an organisation, we can break it down into a value chain. And what we mean by that is this sequence of business functions in which value add for the customer or usefulness of the product is added from the customer's perspective. So if we're spending money on something that doesn't add value for the customer that they won't pay for, it's not going to be helpful. So we, as management accountants, we want to think about our organisation and think about the value chain and think about the costs that are incurred in each part of the value chain and whether they're actually adding value for the customer, and if not, how do we reduce those costs by influencing the managers to make decisions that reduce that activity that's not value added. So we can provide information about key success factors in each of the value chain parts. So what do I mean by a value chain? We can think about an organisation and break it down into, say, research and development, all the functions around that, product, service, process design, the actual production, which we'll be focusing on in this course because we're really interested in understanding the costs in manufacturing, how to cost product from a manufacturing perspective, but then there's also marketing costs, distribution costs, and customer service costs. So we break up the organisation into this value chain, these different business functions, so we can focus on what is value adding in, what activities are value adding in each of those functions. Okay. So the other thing that you have to be aware of is, as management accountants or managers, is that we're providing information to assist decisions. What is the decision-making process? So to make a decision, you have to actually, first of all, identify what the problem is. So if I'm a manager and I identify that there is a problem because there's a new competitor, producing a product at a lower price and selling it at a lower price than we are. So this is the problem. So what do? Well, I obtain information. I need information about what are our costs and what are my competitors' costs. And then I make predictions about the future. So if I can reduce my costs, what will my profit look like in 6 months' time? So I want to forecast, if I make this decision, what the effect of that decision will be. And based upon different alternatives, so your management accountant would provide reports or budgets or forecasts about if you do this, this is what your profit will be, versus if you do the alternative, this is what your profit will be. So this enables the manager to decide which course of action they're going to take, and then they need to implement the decision. And once they've implemented, if they've decided to do A, then the management accountant can assist with information to evaluate performance. And that's a lot about what we do. We compare what we budgeted to happen, how many we expected to sell, what it would cost us to produce that amount of output, with what we actually sold, how much we sold it for, how much it cost us. So we can then say, okay, we achieved budget, we exceeded budget, so what did we do right? We want to repeat that. Or we didn't achieve budget. What's going wrong? Did we sell enough? If we didn't sell enough, is it because we're not marketing well? So we need to evaluate performance and eventually respond to those divergences. Having this information is not helpful if you don't actually act upon it. So we know we didn't meet budget. Why? What are we going to do about it? It may be our strategy is wrong. We might actually have to change our strategy. So it's important that you understand these steps in the decision-making process, and that's useful in general, not just for management accounting. So we talk about the first 4 steps as planning, and we talk about the next 3 steps as control function of the management accountant. And you'll hear this all the time. We talk about control system design, management control systems, which are all the activities that you undertake to encourage the organisational participants to achieve organisational goals. So it's very broad. Okay. Okay, so an example. So say we're in an organisation that we're selling advertising, and our goal is to increase our advertising rates by 4%. So we create these budgets that predict what our expected advertising pages sold, the number we expect to sell, the rates per page and the revenues. And then in the control function, we implement an increase of 4% in our advertising rates. So we're increasing what we charge for advertising. And we accumulate information about those transactions. So this is the actual in our accounting system. And then we evaluate our performance. And what actually happened was we found that actually our advertising revenues were 5.4% lower than we budgeted. And we found that because what we did was we compared our actual results that we accumulated in our accounting system with our budget. And we worked out the variance, whether that's positive or negative, and then we fed that information back to our managers to help them to make decisions. Should they continue on with this increased rate or not? So an example, very simple example, you'll get at the end of the semester when we do variance analysis, we do very complex examples of breaking down these differences between actual and budgeted to understand why you didn't achieve budget. So here we've got this example of this pet shop where these are the budgeted figures for our profit and loss, and these are the actual, and this is the variance. And the variance just means the difference between budgeted and actual. So if you're looking at this report and you're advising managers, would you be saying to them that they should be happy with this outcome? Happy? What do you think? You can start off by looking at the bottom line. The budget, we expected to make 9,000 profit income, but we made 8,700. So is that good or bad? Bad. Okay, so here with the difference of 300, which is, does anyone know what the U stands for? Sorry? Good point, but if we compare it with the F, so under, it is under budget. It also stands for unfavourable. Okay? It's unfavourable because we're talking about the effect on profit. Okay? So this bottom line, if we look at the top line, the revenues, we budgeted to make 59,000 in revenues. We actually made 60,000, so we had a favourable variance because we achieved higher than budget in our revenues, we would increase profit, and therefore it's a favourable variance. Here we have all the costs, and they're all two of them are unfavourable, one's favourable. So why are costs, if budgeted costs are lower than actual, why is the variance unfavourable? Because if costs are higher, profit's lower. Does that make sense? Okay. Excellent. Okay, so we have 3 guidelines that management accountants follow when they're designing management accounting systems. They always want to employ a cost-benefit approach to resource allocation decisions. So if you're going to spend money finding out more accurate costs, are you going to get a greater benefit? If not, there's no point spending that money, incurring that cost, if you're not going to have greater benefit. We also have to think about the effects of the reporting that we do. The information that we provide can have behavioural effects. It can be positive. That information can motivate managers to make decisions in the best interests of the organisation. In some cases, you might produce a report that can be demotivating. You might be producing a report that says we should close down this division and get rid of these employees because we're not covering our costs in this particular division. You have to think about the effects, those behavioural effects. Is that going to actually affect employee morale across the whole organisation? If that's the case, we need to be aware of that and take steps to try and reduce the impact, the behavioural impacts, negative behavioural impacts. So we're trying to always think not only about the cost benefit, but also the wider impact of management accounting. You also have to think about the technical aspects. Are we providing the appropriate information to make the right decision? And this third one, using different costs for different purposes. This will become clearer to you as we move through the course, but one size doesn't fit all. So using total costs, lifetime costs of a product is not useful for financial reporting, calculating cost of goods sold on your profit and loss. But you need that information if you're going to price the product, because you have to cover all your costs, not just your manufacturing costs. So you'll use different costs for different purposes. Okay, so we're up to the third objective of your lecture today that I hope that you will consider, and it's very important. You will definitely come across this in some of your assessment, because ethics is very important for management accountants to be aware of the professional bodies and there are a number of professional bodies for management accountants in the UK, Australia and the US, that actually require members to comply with ethical standards. And those ethics are around these 4 characteristics of behaviour. So we want management accountants to be competent. Very important that management accountants maintain a level of professional expertise, have up-to-date skills, and provide accurate, clear, concise and timely support and recommendations to their firms. We also have to think about confidentiality. If you're a management accountant working for an organisation, some information that you'll be handling will be proprietary information. The firm won't want you to share that information outside the firm because it might cause a competitive disadvantage to the firm. So you have to refrain from using information unethically or illegally. You also need to act with integrity, avoid actual conflicts of interest, and if there is a conflict of interest, you need to make it known. So for example, if I'm a management accountant for a firm and I'm related to a supplier and I'm involved in providing information to choose a particular supplier, I'd need to make it known my relationship with that particular supplier. So you want to communicate to avoid apparent conflicts of interests and refrain from unethical activities like taking expensive gifts from suppliers or customers, and abstain from activities that would discredit your profession. The final one, credibility. This is about being unbiased, providing objective information fairly so that managers can make informed decisions without being unduly influenced. So I would commit to memory these characteristics of ethical conduct. Does anyone have any questions about that? Okay. We're going to have a break for 10 minutes. And then we're going to get into the more technical part and the example that I'm going to demonstrate to you. If you have any questions, please come and talk to me in the break. Okay, can you hear me up the back? Yep, great. Okay, so remember I said to you with a new discipline, there's always terms that we start to use that have a specific meaning in that discipline. So in management accounting, you're going to come across lots of different terms, and we're focusing on costing initially. So we want to define what we mean by cost. So in this case, cost is a resource sacrificed or foregone to achieve a specific objective. So it's usually expressed in monetary terms. So a cost, what I pay for a good or a service. The actual cost is what I physically paid. The budgeted cost is what I predicted I should have paid. Okay, so you also would be familiar with the term opportunity cost. Can anyone tell me what opportunity cost is? Yep. Yeah, the cost that you forego of the next best activity. So you're foregoing being outside in the sun, being in here at this lecture. So the opportunity cost of being in here is not being out there. Okay. So we use different costs for different purposes. So just to explain that, if we're using costs for costing and external reporting, so by external reporting I mean creating the profit and loss and the balance sheet, financial statements for external users, I'm going to have to use the costs that are prescribed when I'm calculating my cost of goods sold under the accounting standard. So if I'm a manufacturing organisation and I'm calculating my cost of goods sold, I can only include manufacturing costs, not period costs, and we're going to go through that a little bit later. If I'm costing for other internal decisions like pricing and profitability, I want to include the costs of the whole value chain. So what it costs me for research and development, for prototyping my product, for producing my product, for marketing it, for distributing it, for after-sales service, because if I don't include all of those costs and to make my pricing decision, I'm not going to be able to make a profit. If I'm just including my manufacturing costs, I have to guess what all the other costs are to put a big enough margin on those manufacturing costs to ensure profitability. So different costs for different purposes. So for planning and control, for budgeting, I'm going to use budgeted costs or forecast costs rather than actual costs. It might be that I rely on the historical costs in order to set my budgets. I might predict that my forecast will be 5% increase on those costs, but I use budgeted rather than actual. And I also need to understand how costs behave, because when I do this planning, as you'll learn next week, some costs behave in a variable fashion, which means that they increase as the units of product increases, and some costs stay static. They're fixed costs. So the behaviour of costs influences our planning. So then also remember we talked about control, how management accountants play a role in control in organisations by creating information. And so we will compare our actual costs with our budgeted costs to work out if there's a variance, and then we will investigate why that variance occurred. We also are interested in how costs behave because that will affect whether we have a variance or not. And we want to think about who has responsibility for those costs and can they control them? Or is it something that's outside of the manager's control and therefore they shouldn't be penalised for any kind of variance? So we need to think about how different costs, we use them for different purposes. So more terminology, and this is a very important slide. You need to understand this. If you're going to cost anything accurately, you first of all have to identify what your cost object is. A cost object is anything that you want to have measure the costs for. So it could be a single unit of product. You might want to measure the costs of a single unit of product. You might want to measure the costs of a product line, which would also include research and development, etc., marketing of that product line. You might want to measure the costs for the production line or the factory or the company as a whole or an individual customer. But you can't measure those costs unless you very specifically identify what your cost object is. Then when we create a cost system to determine the costs of our cost object, we first of all accumulate the costs. All this means is that we have to have some kind of system of accounting. Accounting means recording the transactions and classifying them. So that's cost accumulation. We enter all the transactions into our accounting system, into the different accounts in our chart of accounts. Now, does everyone know what the accounting equation is? Yeah? Can you tell me what it is? What's the accounting equation? What are assets equal? Plus owner's equity. Excellent. So what's the nature of an asset? Is it a debit or a credit account? Debit. What's the nature of a liability? Great. Owner's equity? Great. Now what about your revenues and expenses? Revenues are credit? Why? Why are revenues a credit type account? Yep. Yep. But revenues and expenses appear on your profit and loss, which is a statement of financial performance, and it closes off at the end of each financial year. And the profit, where does the profit go? Where does the profit from your profit and loss go at the end of a financial year when you open up a new... Yep? Dividends? Exactly. Dividends or retained earnings. It's either paid out or it rolls onto your balance sheet as retained profits. Okay, so the effect of a revenue is credit because what does it do to owner's equity? Increases. Fantastic. What about expenses? Are they debits or credits? Debits, because they decrease profit and therefore decrease owner's equity. Okay? So, that's the system we're accumulating our costs in. And then what do? We assign those costs to our cost object. So this is what you're learning about, costing systems, where we're assigning costs to cost objects. And we can assign costs in two ways. We can either trace a cost, and a cost is traced if it can be done in an economically feasible way. What that means is that we need to be able to identify that that cost belongs to that cost object without spending a lot of money. So if I use the example of a company that makes computers, I'd be able to identify for the monitor that the screen is a direct cost of that monitor. I can trace it to the monitor in an economically feasible way. I know there's only one screen in the monitor. I know the cost of that screen. So that would be regarded as a direct cost, and it would be traced to that cost object if the cost object is the computer with the monitor. Is everyone okay with that? So cost assignment is where we assign cost to a cost object. If it's a direct cost, we trace it. If it's an indirect cost, we allocate it. So indirect costs are costs that are spread across lots of cost objects. So using my example of a computer and a monitor, if I have a factory where I'm making all these computers and monitors, and I pay electricity for the factory, I couldn't trace exactly how much electricity was used to make that one unit, that one screen, or that one monitor. But I can know how many monitors I made, and I can divide up that electricity across all the monitors. So I can allocate some electricity cost to that particular cost object. Does that make sense? Same goes for the lease on the factory, the depreciation on the factory equipment, the plant supervisor's salary, because I'm not going to go along and watch how long he watched that person making that particular monitor, so I can trace part of his salary to that monitor. I'm just going to take his salary and include it in my indirect costs and then allocate it to that cost object. So this is just your definitions. Direct costs are costs that you can trace in an economically feasible way to your cost object. And indirect costs, only indirectly identified with the particular cost object, they can't be traced in an economically feasible way. So this is a diagram representing what I've just told you. So we accumulate our costs in our accounting system, and then what we're doing, what we're learning about, is assigning those costs to our cost object either by tracing our direct costs or allocating our indirect costs. Our indirect costs are spread across many different cost objects. And we have to have a system for doing that. So the course is structured around understanding how we cost in a manufacturing environment. And there's not as much manufacturing in Australia as there used to be, but it is used to demonstrate the process of costs flowing through inventory accounts to calculate cost of goods sold. You also have to be aware that there's obviously merchandising organisations and service organisations, and they are going to cost their services and their merchandise differently to how a manufacturing organisation would do so. So manufacturers make things by taking material, adding labour and overhead. Merchandisers, what do? Do they make things like David Jones and Myer? What do? They resell. So they buy off the manufacturer or the wholesaler, and then they resell it. And service organisations, they create intangible products like hairdressers and lawyers and health organisations. So they all have balance sheets that look different. And their cost of goods sold is calculated differently. So can anyone tell me what type of account an inventory account is? What's an inventory account? Is it it's an asset. So for a merchandising firm, for example, you would have inventory account that represented all the stock that you have in your stores ready to sell to customers. Does that make sense? So you'd have one, you might have lots of subsidiary accounts, but you'd have one inventory account. Manufacturers are different. Because manufacturers buy in material to put on the production line, they have an inventory account for their material. And we call that materials control account. It's an asset account. Then they put that material on their production line, they add labour, they add overhead to make their product. While the product's partly made, they've added all these costs, that material comes out of the inventory account material and goes into another account that we call work in process, which is also an inventory account. Okay, but what happens to all those products? They don't just stay on the production line partly made. What happens to them? What happens to the products? What do we do to them? We finish them and we sell them. Okay, we might have a stock of finished goods at the end of the period, the accounting period, that we haven't sold, but those partly made goods become finished goods, and the value of those finished goods is transferred out of that asset account, work in process, and into the finished goods account, which is also an asset. So we talked about 3 assets for a manufacturer and only 1 for a merchandiser. Does that make sense? So what we're learning about is how the costs flow through those asset accounts and what happens to our finished goods after we've completed them. What do we want to do with them? Sell them. So the value of the goods that we sell comes out of our finished goods account and becomes what? Cost of goods sold, and that's an expense that appears on our profit and loss. So that's what I'm talking about when I talk about cost flows in a manufacturing organisation. Okay, and that's what we're going to learn about and be able to produce a schedule of cost of goods manufactured and sold. So this is just a diagram relating the merchandising firm and the manufacturing firm to try and demonstrate to you in the production process we take materials, we add labour, we add other manufacturing costs, electricity, depreciation, the lease, there's plant supervisors, managers, salary, etc. Then we have a stock of completed items, our finished goods, and we eventually sell them to the customer. So in order to be able to cost our goods for external purposes, what we report in our financial statements, we have to, under the standard, only include in that cost of goods manufactured and sold figure manufacturing costs. So you need to identify which costs are manufacturing and which are non-manufacturing. So manufacturing costs are the costs of obtaining and transforming that material into the finished product. We call that also product costs. So they're your manufacturing or product costs. They're also referred to as inventoriable costs. And that's because those costs appear in those inventory accounts on your balance sheet at some point. Is that okay? Then we have to classify non-manufacturing costs as period costs, and we expense period costs in the period in which they're incurred. So your non-manufacturing costs include your distribution costs, your selling costs, your marketing costs, research and development, and general and administrative costs. You can't include those in your cost of goods sold figure on your financial statement. Only manufacturing inventoriable costs. So this figure just is demonstrating to you what I've just explained. You have to be able to identify which costs are manufacturing, product or inventoriable costs, which costs are non-manufacturing costs that go straight to your profit and loss as an expense. So for our manufacturing costs, we generally have direct materials, direct labour, and overhead. Overhead can be made up of indirect materials, indirect labour, and all those other costs like electricity, leasing, depreciation, and salaries. And we can further refer to direct materials and labour as prime costs, and our labour and overhead as conversion costs. So more terms that are specific to management accounting. So prime costs are direct material and direct labour. Conversion costs are your direct labour and your overhead. And conversion just means you're converting your material to the product. Okay. So as I said, we tend to have direct materials as manufacturing costs. So that's the acquisition costs of all your materials that become part of your cost of goods sold. That includes the freight in of the material. Direct labour, so the compensation for the people who you can directly trace as producing the product. And then manufacturing overhead, which includes all the indirect costs related to that cost object. So you can have indirect material, so material that you can't trace in an economically feasible way to that cost object. You can have indirect labour. You can have all these other overheads like rent, insurance, depreciation, and compensation of the plant manager that you would allocate across many different cost objects. So remember, we said we have to accumulate the costs in our accounting system, then we assign our costs to our cost object by tracing and allocating. So we trace direct costs, we allocate indirect costs, and for a manufacturing organisation, we have to trace and allocate our manufacturing costs if we want to calculate our cost of goods manufactured and sold. Okay, so we're just going to go through, and you're going to tell me for each of these, is it manufacturing or non-manufacturing? So for assembly line labour, so assembling your product, is that labour manufacturing costs or non-manufacturing cost? Manufacturing? Is it going to work? Yeah. What about freight out? So when I finish the product and I send it to the customer, is that manufacturing or non-manufacturing? Non, it's delivery, okay? What about freight in? When I freight in my material, is that included as a manufacturing cost? Yep. What about office supplies? No. That would be a period cost. It would be expensed in the period in which it's incurred. What about depreciation on the factory equipment? Would that be manufacturing or non-manufacturing? Manufacturing, because it's about the factory. If it's about where you're actually physically making the product, it can be included as a manufacturing cost. What about the general manager's salary? Non-manufacturing, it's a corporate level cost that would be expensed in the period. What about sand if you're in a glass factory? It'd be a manufacturing cost because you use the sand directly to make the glass. What about factory rent? Manufacturing. Great. So, as I said to you before, in the manufacturing organisation we have these 3 asset accounts. Your direct materials, or it might just be called materials or raw materials. For when you purchase the material, you will increase the asset account materials. So that's your inventory account. Then when you take that material, you put it on the production line and you start making your product, the value of that material, the cost of that material comes out of the materials account and flows into your work in process account. So it will be credited from your materials account, decreasing the materials account and increasing your work in process asset because now it's becoming part of your product, to which you will then add your labour and your overhead. Once the product is finished, the cost of that product is taken out of work in process as a credit and added to finished goods, another asset account. That amount has a name. That is your cost of goods manufactured. The cost of the finished goods that is taken off the production line and put into your store to be sold to the merchandiser or direct to the public is your cost of goods manufactured. It comes out of work in process and into finished goods. And then when you sell that good, the cost of that good, cost of goods sold, is taken out of finished goods asset account and it becomes an expense on your profit and loss statement. As I said to you before, product or manufacturing costs are also called inventoriable costs because they flow through these inventory accounts on your balance sheet. And all those other expenses, the selling and administrative expenses, we refer to as period costs because they're expensed in the period in which they are incurred. So just to reiterate, if I'm a merchandiser, my balance sheet will have a single control account for my inventory. If I'm a manufacturer, I'll have these 3 inventory accounts: raw materials or materials, work in process and finished goods. Okay, so if I have an income statement extract for a merchandiser, I would have, and I want to work out my cost of goods sold for a merchandiser, I would take my beginning merchandise inventory amount. So this is how much the value of all your inventory you had at the beginning of the period, to which I would add my purchases, and this gives me my cost of my goods available for sale. So that's not cost of goods sold, that's co-gas. It's cost of goods available for sale. If I take away my ending merchandise inventory value from co-gas, I can calculate cost of goods sold. Does that make sense? So what I had at the beginning, what I purchased, gives me what I have available for sale. If I take away what I had at the end, so if I went and counted my stock on the 30th of June and I took that value away, I could work out what my cost of goods sold is. Does that all make sense? You can do it in a T account, if you're familiar with T accounts. Okay, for a manufacturing company, what we start off with is the beginning finished goods inventory. So this is the value of the goods I had that were completed at the beginning of the period, so 1st of July, to which I add the cost of goods manufactured. This is the value of all the goods that I complete during the period, and that gives me my cost of goods available for sale. And then I take off my ending finished goods inventory, So this is the value of all the goods that I didn't sell, that are completed, and that will give me my cost of goods sold. So see, here we have purchases, here we have costs of goods manufactured. So I want you to be able to calculate this figure, cost of goods manufactured. Okay, so we're going to do the flow of costs so that you're able to calculate this figure and present it in a cost of goods manufactured and sold schedule. So just going through that again, I purchase materials, that increases my asset account raw materials. I then take those materials and I put them on the production line. They become part of my work in process asset account, to which I add direct labour and overhead to convert that material into the finished product. Once the product is finished, the cost of that product is then transferred to my finished goods account, and once the finished good is sold, that value or the cost of those finished goods is taken out of finished goods and it becomes an expense cost of goods sold. All these other costs are period costs and they're expensed immediately that they're incurred. Okay, so this is kind of how we would do it in an equation method. We take our beginning materials, we add on what we purchase, that gives us how much material we'll have available. We take off what we have left at the end so we know how much material we've used. So we want to work out the direct materials used because that material has to be added to our manufacturing costs. We add on to those direct materials our labour and our overhead, and so we know the total manufacturing costs we've incurred in the period, in the accounting period. So those total manufacturing costs are then added to our beginning work in process inventory, so we know how much total work in process we have for the period. Take away how much the cost of the partly finished goods that we have left on our production line at the end of the period, and we know our cost of goods manufactured. That's the amount that comes out of work in process and is added to finished goods. So beginning finished goods plus cost of goods manufactured gives us COGAS, less our ending finished goods inventory gives us our cost of goods sold. It's a lot to take in, but I really want you to think about it in a very practical sense. I'm taking the material out of, I'm buying the material, putting it in my store, taking it out of my store, putting it on production line, adding labour, adding overhead, finishing my units. Then they're transferred to finished goods, store, taken out of the store when they're sold. And what we're trying to do is put a number to those cost of goods manufactured and cost of goods sold figures. So that cost of goods sold is an expense account. Our income statement lists our revenues, then our cost of goods sold to give us our gross margin, less our operating expenses to give us our operating income. Okay, so some work for you to do. We've got beginning materials inventory, so we had $32,000 worth of material on hand at the beginning of the period. During the month, we purchased $276,000 worth of material, and at the end of the month, we did a stock take, and we had $28,000 worth of material still present. So what's the cost of our direct materials that we've used? Does anyone have an answer they'd like to share? Anyone have a guess? Number 3? Fantastic. How did you get that?
So beginning cost plus purchase minus the minus, then you get the material left over.
Fantastic. So you take the beginning of 32,000, you add on what you purchase, you take away what you have in the ending inventory, and so you know that you have used $280,000 worth of direct material, and you need that amount to add to work in process to calculate your total cost of manufacturing. Does anyone need me to repeat that? Great. Okay, a theoretical question which you need to understand because these terms mean different things. So if beginning work in process, so we have an asset account beginning work in process, is higher at the beginning of the period than at the end of the period, which of the following is true? I find putting numbers to this really very helpful. Does anyone have? Sorry? Does anyone have a response? What if we put some numbers around it? So what we're saying, for example, our beginning inventory, what if we said our beginning inventory was $25,000? That's not going to work. What if our beginning is $25,000 and we add to that our total cost, manufacturing costs for the period? So all our direct material, our direct labour, our manufacturing overhead, and that comes to $1 million. It's just an example. And we know that our ending inventory is less than our beginning inventory, so I'm going to make it 20,000. So this is beginning plus what we've added, our total manufacturing costs. That will be 1,250,000. Our ending inventory is 20,000, so our cost of goods manufactured must be 1,005,000. So if our beginning inventory is higher than our ending inventory, our cost of goods manufactured must be greater than our total manufacturing costs. So does everyone understand that? So if you get this kind of question on a quiz, put numbers to it. So you know that your beginning work in process plus your total manufacturing costs less your cost of goods manufactured, that's the value of the finished goods that you complete and transfer out, has to equal your ending inventory, so you can work it out. Okay? We all good? Great. So one final one. If we have finished goods at the beginning of the period of 125,000, during January, the total manufacturing costs were 870,000. The cost of goods manufactured was 835,000, and cost of goods sold was 900,000. What is the ending finished goods inventory? Be careful, you don't have to use all these numbers. One of the numbers you don't need. Does anyone have an answer for me? Fantastic. How did you get 60,000? Yep. Yeah, so if you started with your beginning finished goods of 125,000, you added on your cost of goods manufactured of 835,000, took away your cost of goods sold, you'd end up with 60,000, which is your ending balance of your finished goods account. So when you do this type of question, be very careful to read which account we're talking about. In this case, it's finished goods, so the appropriate value to use is cost of goods manufactured, not total manufacturing costs, which are the costs that you added to your work in process account. Okay, so just reminding you the income statement for a manufacturing firm. We're going to have our revenues less our cost of goods sold, which we calculate using our finished goods account. Gives us our gross profit less our operating costs. Okay, so this is what you have to be able to do. You have to be able to create a schedule of cost of goods manufactured and sold. So to do that, you want to calculate the manufacturing inputs, and to do that we need to know the direct material that we've used, the direct labour that we've used, our overhead to get the total manufacturing costs. We need to add that to our work in process opening, take away our work in process closing, and that will give us our cost of goods manufactured. Then if we have to do a cost of goods sold, we take our cost of goods manufactured, add it to our finished goods opening, take away our finished goods closing, and that will give us cost of goods sold. So I'm going to do this quick, but after today's lecture, you'll be able to see a video of this also in your Blackboard site, so you don't just focus on following me now, but you don't have to jot down all the notes because you'll have this with you. I just want to do. Okay, so our question, we have, and this is typical, you'll be given information. So we're given information about different types of expenses and our inventory balances. So we've got our materials inventory balances, our work in process inventory balances, and our finished goods balances. So they want us to prepare a schedule of cost of goods manufactured, cost of goods sold, and then do the income statement, which is a very simple example. If you're asked to do a schedule, you have to give it a title. So we know this is for Acct company, and it's a schedule of cost of goods manufactured. How do I make this bigger? Okay, so we would have a title, Acct company, schedule of cost of goods manufactured for the year ended whatever year in the question. So you can use shorthand, you don't have to write out cost of goods manufactured. We will know what you mean using COGM. So the first thing we have to do is calculate our direct materials that we have used. So what information would we look for? What information in this list of information would we look for to calculate direct materials used? We want to know, we've got our raw materials inventory at the beginning of the period and the end of the period. So we know we had $90,000 worth of material at the beginning of the period. What else do we need to know? What do we add to that balance? We have purchases, great. So we've got purchases of raw materials of $750,000. So if we have the beginning of $90,000, we purchased $750,000 and we had $60,000 left at the end, it means we've used the difference as direct material. So we take our opening inventory of $90,000, add on our purchases, take away our closing inventory, and we know that we've used $780,000 worth of direct material. So that's the first thing. The next thing we have to do is our direct labour. In our list, they actually very kindly give us our direct labour cost of 150,000. So if I was in an exam situation, I'd tick off all of the things that I've used so I don't keep going back and looking at those same amounts. So I add to my direct materials my direct labour of 150,000 that comes from here. Then what? So I've got direct material, direct labour. What's the last cost? Manufacturing cost. Overhead. So are selling expenses overhead? Manufacturing overhead? Do I include selling expenses? Is that manufacturing cost? Are selling expenses a manufacturing cost? No. Okay. These are inventory accounts. We ignore those. What about electricity and gas? Yep. We've already included direct labour above. What about depreciation of factory equipment? Yep. What about sales? That's a revenue. What about insurance for our factory? Is that manufacturing overhead? Yeah. Yep, because it's related to the factory. What about supplies for the factory? What about administrative expenses? No, that's a period expense. What about indirect labour? Yep. What about maintenance? Great. And these last figures, there are inventory balances, so we ignore those for the purposes of calculating our manufacturing overhead. So I've got my direct materials, I've got my direct labour, I'm now calculating my manufacturing overhead, so I'm taking the electricity for the factory and the electricity and gas, the depreciation, the insurance for the factory, the supplies for the factory, the indirect labour and the maintenance, and I total those. So my manufacturing overhead, if I total up all those amounts, is 640,000. So the direct materials, direct labour and manufacturing overhead, if I add those together, gives me the total manufacturing costs. So those total manufacturing costs, what do I do with that figure? I'm trying to work out the cost of the goods I've manufactured, finished in the period. So what do I do with this figure here? Which account does that go into? Total manufacturing costs. Fantastic. So we know that the beginning work in progress is 180,000 and we know that the ending work in process is 100,000. So we take our total manufacturing costs, add that to our beginning work in process, and that will, if we take off our ending work in process, we know the difference is our cost of the goods that we've manufactured. So the goods that we completed during the period is 1,650,000. So that's a schedule of cost of goods manufactured. If we have to calculate our cost of goods sold, we then take that amount, and what do we have to do? Cost of goods manufactured is added to which account? Finished goods. Okay, so we've got our beginning finished goods and our ending inventory of finished goods. So we can say, okay, if we have our beginning finished goods of 260,000, we add our cost of goods manufactured, that we take off our closing finished goods, and that will give us our cost of goods sold figure. So we've managed to do a cost of goods manufactured and sold by going through this list and identifying which are our direct materials used, our direct labour and our manufacturing overhead, and using the balances of our inventory accounts to calculate those figures. That cost of goods sold is then put into our income statement. So we're told that we have sales revenue of 2.5 million. We can take off our cost of goods sold of 1.7 million to get our gross margin of 800,000, and then we take away those other expenses. Remember, we had selling expenses and administrative expenses. which were operating expenses. So we take our gross margin less our operating expenses gives us our operating income. But remember, you've got a video of this demonstration available to you that you can revise. Okay? Thank you very much. I'll see you next week.